Have you ever wondered how companies always know exactly where their money is going? How they can say, yes, we made a profit this quarter, or oops, time to cut down on expenses. Well, welcome to the world of R2R, Record to Report. In the next 10 minutes, we'll break this down step by step. From the old school, traditional way to the modern, ERP-based approach, and finally, the key differences that make today's finance teams smarter and faster. Whether you're a finance professional, an aspiring accountant, or just curious, stick around. By the end, you'll speak the R2R language like a pro. 1. Introduction to Record to Report, R2R. So, what exactly is R2R? Think of it as the financial diary of a business. Every single transaction, money spent, money earned, gets recorded, summarized, analyzed, and reported. Why do we do this? Because it's not just about maintaining books. R2R provides strategic, financial, and operational feedback that helps leaders understand if the business is thriving or needs a serious course correction. Who owns this process? Usually, it's managed by the controller function, basically the watchdogs of financial accuracy. And if you're in an ERP-based organization, you'll hear the term R2R a lot, because ERP systems have transformed the way this process works. More on that in a bit. The traditional R2R approach. Before automation, accountants did everything manually. And honestly, it was a lot of work. Let's break down the traditional 5-step R2R process. Step 1. Journal entries. This is where it all starts. Recording every financial transaction. Think of it as writing down every expense and income in a diary. You buy office stationery? That's an entry. You close a $1 million deal? That's another entry. Step 2. General ledger. Next, these journal entries get moved into the general ledger, which is like the big, organized book that shows total debits and credits in each account. If journal entries are rough notes, the ledger is the polished, final version. Step 3. Trial balance. Once all entries are posted, accountants prepare a trial balance to ensure that the sum of debits equals the sum of credits. If it doesn't match, well, accountants aren't going home early that day. Step 4. Profit and loss account. Now comes the profit and loss, P&L account, where expenses and incomes are summarized to calculate profit or loss. This is the moment of truth. Are you making money or just burning cash? Step 5. Balance sheet. Finally, everything ends up in the balance sheet, the ultimate financial report card. It tells you what you own, assets, what you owe, liabilities, and your overall financial health as of a specific date. 3. ERP-based R2R approach. 6:01 to 9 o'clock, fast forward to today, and we've got ERP systems doing most of the heavy lifting. Here's how the modern ERP-based R2R works. Step 1. Recording of transactions. Instead of manual entries, ERP systems automatically record financial transactions and interface them directly to the general ledger. Imagine having a robot accountant who never sleeps. Step 2. Summarizing. The system classifies transactions into the right accounts automatically. No more confusion over which expense goes where. It's all predefined. Step 3. Reconciliations. Reconciliation is still crucial, but ERP tools make it faster. They flag mismatches and balances instantly, reducing errors and saving hours of manual checking. Step 4. Analysis. Here's where ERP shines. You can generate instant misreports, variance analysis, and trend charts. This helps business leaders make decisions much faster. Step 5. Reporting and finally reporting. P&L, balance sheets, and even external financial statements are generated with just a few clicks. Finance teams now spend less time entering data and more time analyzing it. Key differences between traditional and ERP-based R2R. So, how do these two approaches compare? Let's simplify it. Automation in ERP-based R2R. 80 to 90% of journal entries are automated, with features like mass uploads and auto-reversal of accruals. Traditional R2R, mostly manual. Focus shift. Traditional R2R spends a lot of time recording transactions. ERP-based R2R reduces that effort, allowing finance teams to focus on analysis and reporting. Decision-making. ERP delivers timely, meaningful insights, improving business decision-making. In traditional methods, by the time reports were ready, decisions were sometimes too late. R2R subprocesses. Now let's quickly go through the 5 key subprocesses of R2R. These are common to both traditional and ERP approaches. Recording of transactions, capturing every financial activity, summarizing accounts, organizing entries into proper accounts, reconciliations, ensuring closing balances are accurate. Analysis, reviewing variances and trends to understand financial health. Reporting, preparing P&L, balance sheets, and external reports. Closing and key takeaways. So that's record to report, R2R, in a nutshell, from its traditional roots to today's automated, ERP-driven approach. Key takeaway? Traditional R2R gave us the foundation, but ERP-based R2R gives us speed, accuracy, and better insights, which is why modern finance teams rely on it heavily. If you're building a career in finance or accounting, understanding R2R is essential. It's the backbone of every business's financial health. Thanks for watching. If you found this helpful, stay tuned. We'll be diving deeper into each R2R subprocess in upcoming videos. Subscribe to my channel so that you don't miss the notification.